Hi guys, welcome to this video on active funds versus passive funds. So what we are going to discuss in this video is there are so many mutual funds in the market. So if you go, you have HDFC mutual fund, Kotak mutual funds. There are so many mutual funds out there in the market. So what we are going to discuss is it actually worth investing in these mutual funds? So what is the alternative to investing in these mutual funds? You have basically two alternatives. One, you have to pick stocks by yourself. So that is not an easy process because you have to do a lot of analysis. You will have to understand the business well, and you will also have to have some additional capital, and investing by yourself is not an easy task. So you will have to have some huge capital as well, because if you want to start with say around 10,000 rupees, you're not going to find a lot of good companies. You might only end up buying one share or two shares of two good companies and your capital will be exhausted. So picking stocks individually is not a great option for people with lower capital. So what can they resort to? What is better than investing in a mutual fund? So the simple answer to that is Nifty. So if you see Nifty from the year 1999, you can see the growth is literally exponential. So the growth has been really amazing for Nifty. So the average growth rate for Nifty from past almost 20 years has been around 12 to 14% a year. So this growth rate is something really high, and this is much more than what you can expect from a normal bank FD or something like investment in gold. So now the question is, does this actually make a difference? How much difference can this 12% make over 7%? It's just 5%, right? If gold is giving me 7% or FD is giving me 5%, it is just going to make some difference, but my money is safe. Why do I actually want to risk it? So if you have this question in your mind, then I have attached the video on top. The link is also in the description about power of compounding. So we had done this video some time back. So please do go and take a look. So you will understand why each percentage point matters when it comes to compounding in the longer run. Index funds are achieving around 12 to 14% per annum from almost a decade now. The question what we have to ask is, are they actually doing better than mutual funds? So we will find that out. So I am going to open an article. Here is an article which I have opened from Financial Express, and you can see that it is dated 8th April 2021, around 2-3 months back. So I am just going to read out this article. I can also show you a comparison year wise, but I'm just going to read out this article. So you can see that active fund managers faced a hard time mirroring the up move in index. 81% of large cap equity funds failed to outperform S&P BSE 100 index. So S&P BSE 100 index is again something similar to Nifty 50, but instead of top 50 companies, S&P BSE 100 has top 100 companies. So 81% of the mutual funds failed to outperform S&P BSE 100 index, which means 81% of the active funds are actually lagging behind the index itself. So why do you want to pay these active fund managers extra money if they just fail to outperform the index itself? That is the benchmark what they are using. So we will just go ahead in the article. So I'll just share the link to this article so you can just read it yourself. So here you can see that the underperformance is not just limited to large cap funds, but also ELSS fund, mid cap fund, small cap fund, and even the government bond fund have lagged the benchmark over 1 year period during December 2020. So you can see that almost all the funds, whether it's large cap or small cap or mid cap, most of these funds, so this is not just 1 year. So here they have mentioned for 1 year. So as we move in the article, you will also get to know that they have consistently failed to outperform Nifty or the benchmark index, whatever they are following. So now I will just go through the article. So as we continue further, we see over 1 year period, that is December 2020, S&P BSE 100 was up 16.84%, with 81% of the funds underperforming, so which we already saw. And over the second half of 2020, so this is most important, 100% of the mutual funds underperformed BSE 100 index. So this is really shocking. How can not even a single fund, single actively managed fund outperform BSE 100 index? It is really surprising, right? Because you pay them additional money right, to give you good performance, but they are not even able to beat the benchmark. Now, as we move forward, you can also see that the comparative index of ELSS fund was up 17.92% in 2020, and it outperformed 65% of the actively managed funds. So the index itself outperformed 65% of the actively managed funds. And similarly, the mid cap and small cap index, so even 67% of the funds, actively managed mid cap and small cap funds, failed to outperform the index itself. So it is really shocking, guys. So just by investing in Nifty or the benchmark alone, I am beating almost 80% of the actively managed funds. What more do I want? I am not even paying them additional fee. So next we will see what is the case for longer run. So whatever we saw now was just a shorter period of time. So you can read the full article. I am just going to highlight the key points. The data showed that actively managed equity funds have underperformed even over longer periods of time. 87% of large cap funds underperformed over 3 to 5 year time frame. So this is just ridiculous that 3 to 5 year time frame, 87% of the funds have underperformed, just couldn't beat the benchmark itself. And 68%, almost close to 70% of them underperformed over 10-year time frame. Okay, so this is large cap funds. Now coming to mid cap and small cap funds, almost 35% of the funds only 35% of the funds actually were able to outperform the index, and 65% of the funds underperformed the benchmark. So this is for 3 and 10 years. So 3 and 10 years. So whereas in 5 years, 54% of the actively managed funds have underperformed the index, so or underperformed the benchmark. So it's really amazing how just investing in Nifty alone or benchmark alone is much better than going and investing in mutual funds. So I am not telling this, the data itself is showing. So you have to pick the top 13% mutual funds. So how do I know which is going to be the next top 13% mutual funds? It's a pure luck, because top 13% mutual funds are the only ones which are able to beat the index. Remaining 87% of the funds underperform the index. So what is the point of me going and putting the money in the active fund? Because I have to get really lucky to identify this 13% of the mutual fund. A best alternative to that is just put in index fund, and you know that if you put in index fund, it is going to outperform 87% of the mutual funds. So what more do you need? So you're already performing better than 87% of the mutual funds. So now the question is, how do I invest in Nifty? Can I buy Nifty at 15,701 unit? How do I actually invest in Nifty? So that is the most important question. So you can invest in Nifty or you can invest in mid cap through something known as ETFs or exchange traded fund. So I'll just remove this. So these three instruments. So all you have to do is, let's say you want to buy Nifty, right? So all you have to do is type in Nifty Bees. So Nifty Bees is a Reliance Nippon ETF index. It's a passive fund. So you can buy it straight from your Zerodha account, Upstock account, FIRSTOCK account, whichever broker you have, you can buy it right from there. So Nifty Bees is the most liquid ETF available out there. Like, I mean to say, this has the highest volume of transaction, Nifty Bees. So what are the other alternatives? So if I want to invest in Nifty directly, I can also put Kotak Nifty. So Kotak Nifty is a ETF by Kotak. Then I can also put ICICI Nifty. So ICICI Nifty is a passive index fund by ICICI. Same way you have HDFC Nifty ETF. So this is a passive fund by HDFC. So you can see that all these are trading in and around the range of 165 to 170 rupees. So you can just buy any one of these and they are going to replicate the performance of Nifty, because you can't directly buy Nifty. I can't buy one share of Nifty because Nifty is not an instrument. Nifty is just a measurement. It's a benchmark which measures the performance of all the shares, right? So you can't directly go and buy Nifty because it's just a unit of measurement which measures the performance of all the shares. So the only way you can purchase Nifty is through Nifty ETFs, and you have all these things with you. So now let's say you want to do mid cap. So how can you do that? So if you want to do mid cap, you can just go and type N ETF mid 50. So if you just buy this, you will be buying into entire 150 mid cap stocks. So similarly, you have NET ETF consumption. So you can also buy the consumption basket. Same way you can buy NET EF IT. So this is Nifty IT. So you can also buy only banking stocks, that is called as bank Bs. So you can see that you can buy these index alone. So I'll just quickly show you what will you get if you end up buying Nifty Bs. So this is how you can buy only banking stocks. NETF IT is only for IT stocks. NETF consumption is only for consumption stocks. Now, what if I want to buy US stocks? Do I have an option? Can I actually buy US stocks? Yes, you can. So there are two ETFs which will allow you to buy even US stocks. So one is called as MAFANG. So MAFANG is by Mirae Asset. Then there is something called as MON 100. MON 100 is Motilal Nasdaq 100 ETF. So these two also you can purchase, and you will directly be investing in 100 stocks in US, 100 stocks in Nasdaq index. So these are the ETFs, and this is how easily you can purchase an ETF. So now the obvious question would be, when I pay 169 rupees to buy this Nifty Bs, where will the money actually go to? So we will see how your money is going to get split. So here in Morningstar, I have opened Nifty Bs, and you can see that if you put 169 rupees into Nifty Bs, 169 rupees, 10%, that is 16 rupees is going to go to Reliance. Similarly, 9% is going to go to HDFC Bank. 9% of that would be somewhere close to again 16 rupees. 7%, which means around 14 rupees, is going to go to Infosys. And similarly, you can see the weightage, where exactly your investment is going to go to. If I press on more holdings, so you can see that these are the exact weightages even Nifty has in its index. So that's the reason this ETF will exactly mirror the performance of index. So you can quite clearly see here. So you can come and check it yourself. There are two pages. You can go to the next page as well. So these are the exact weightage in Nifty 50 index. So now I can check for other one also, that is MON 100. So you can see that if I am going to put 100 rupees into MON 100. So here you can see MON 100 is trading at 106. So I can just go buy this one lot quite easily, right? So if I put 107 rupees, we'll just round it off to 100 rupees. 10% or 11% of that, that is 11 rupees is going to get invested in Apple. 10% is going to get invested in Microsoft. And similarly, these are the actual investments which will take place. So 8% in Amazon, 4% in Apple. So the best part to this is there is absolutely no fee that you will be paying to the fund manager. So no fee at all. So similarly, you can also see, so now we will look at Bank Bs. So you can see that Bank Bs is currently trading at 352. So if I buy 1 unit of Bank Bs, what am I going to get? So I'll just click on detailed portfolio, and I have selected Bank Bs here. So you see that if I put 300 rupees into Bank Bs, so obviously you can only expect bank in Bank Bs, right? So 30%, that is almost 90 rupees and odd, around 100 rupees is going to go into HDFC Bank. Then 20%, which is around 70 rupees, into ICICI. And similarly, you can see the respective weightages. So now here in this particular thing, we saw something called as S&P BSE 100 index, right? So 81% of the funds, 87% of the funds, all these underperformed S&P BSE 100 index. So what is this S&P BSE 100 index? So we can't directly get S&P BSE 100 index, but we will get the same replica, that is Nippon ETF 100. Nippon ETF NIF 100, that is Nifty 100. So this is again trading at 165 rupees. So if you purchase this, it is more or less going to invest in top 100 companies. So this is as easy as it gets. Quite easily, you can end up buying these ETFs without paying any additional fee, and you can also outperform most of the active funds out there. You can close your eyes and outperform most of the active funds out there. So now the next thing, I'm going to make you understand why exactly these ETFs usually outperform the active fund manager. The simple reason why these ETFs will be able to outperform is the fact that when you take Nifty, right? Nifty has top 50 stocks in India. So these are not just top 50 by size, they are also top 50 by performance. So what you have to remember is if some company is not performing well, it will be out of Nifty. So these are top 50 companies in India, and how can they be in top 50? Only if they have performed well, right? So when you have the 50 best performers in India, that too the weightage is given based on the size of the company. What more do you want? Why do you even have to go and look for something else when you have the best 50, the cream 50 with you in an index? Why do you even have to go and look around? So this is the simple reason why simply these funds will be, or these, when I say funds, these passive funds or ETFs will be quite clearly able to outperform the active funds in the longer run, because they already have the best. Where do you get better than the best? Because these things already have the best stocks. So this is one reason. That is, these are already pretty strong benchmark to beat, because you have the top 50 stocks or top 100 stocks in a Nifty 100 ETF. If you already have that, then so it is not an easy task to beat it. So the next question is, what is the charge for this? The simple answer is, it's absolutely free. It's like how you buy your normal equity share. You're not paying anybody a single penny, and still you're performing better than 87% of all the people out there. So it's absolutely free. It's zero the charges, zero for delivery, which means you can just click on buy, enter the quantity and just buy. You're just going to have some transaction charges. Apart from that, there is going to be absolutely no charge. So I will show you one more thing. So you can see right here. So I have small amount invested in Zerodha. I don't have my portfolio in Zerodha. So whatever I had before, so I have invested some amounts. So you can see that I have 185 of Kotak Nifty, and I also have some NetFit, that is Nifty IT bank piece. So I have personally purchased this because even I am a big fan of investing in ETF. So not just that, I have also purchased ETF in upstocks. So I have purchased this MON 100, MAFANG. I have also purchased Nifty Midcap 100. So I have purchased all these in my FIRSTOCK account. So I am just telling you or giving you an idea. Whenever I get some extra cash in hand, I'll just put it in the index funds, because they are the best way to go ahead. So now I will tell you also one more very nice story. So many of you will know it. For those who don't know it, I'm going to tell you a nice story. Right. I'm going to attach this Investopedia article in the description below, so you can go and read this. Once Warren Buffett in 2008 had a bet with a hedge fund manager, and he told that over the course of 10 years, hedge funds can't outperform index funds. So there is no way hedge funds are going to outperform index funds. And Warren Buffett bet $1 million on this, and this amount was going to charity. So they told that if hedge funds are able to beat index funds over the course of 10 years, then I'm going to give 1 million to the charity. So this was the bet taken between a hedge fund manager and Warren Buffett. The hedge fund manager could pick 5 funds, and surprisingly, all these 5 funds underperformed index. So you can see the average return of all the hedge funds put together over 10 years is just 22%, whereas index funds, that is S&P alone, gave 85%. Hands down, hedge funds could not even come close to performing as good as index. You can also read more about the story. I have attached the link in the description. So it's amazing how best of the best hedge funds in the world just couldn't outperform simple S&P 500. It is not just in India, it is also around the world. Even in US, people are not just able to beat the index because it has the best companies. How can you beat it? It has the best. So it's mainly because of the higher fee they end up charging, their returns are going to go down. So it's more of fee rather than the stock picking, because they can pick the best stocks, but if they end up charging higher fee from you, your net returns are going to be lesser. I hope you have liked this video, and this video will make some change to your investment style. And with that, we come to the end of this video. So hope you guys have liked it. Please do like, share, as well as subscribe. Thank you.